The effects of the energy constraints South Africa has experienced, as well as the structural weaknesses in our economy, are reflected in Minister Nene's medium-term budget speech delivered on 21 October 2015. The sobering result has been a downward adjustment of revenue collections by $7.5 billion this year and $35 billion over the next 3 years. Against this backdrop, growth and economic transformation continue and need to be key focuses of the government. But how will this be achieved? Well, from a revenue collections perspective, government will be reassessing and evaluating incentives, such as the employment tax incentive, will be relying on a number of measures put in place to counter corporate profit shifting and transfer pricing, will be looking at some form of wealth tax by clamping down on estate planning, and is seriously considering implementing carbon tax when developed economies like Australia chose to abandon carbon tax shortly after inception. Tax compliance lies at the heart of nation building and social cohesion. Without a buoyant revenue base, a nation cannot develop and succeed. From a dispute resolution perspective, corporate taxpayers can expect more SARS audits and scrutiny of their tax affairs. This in itself is not a problem. What is a problem is when an overzealous SARS oversteps the boundaries of the Tax Administration Act under which it operates to effectively tie up corporate taxpayers in long, protracted audits, sometimes going into prescribed years, which ultimately can harm the economy, damages corporate reputations, and may kill the goose that lays the golden egg. I would recommend that time limits are included in the regulations, similar to what Australia has, where, say, SARS commits to resolving a tax matter within 2 years from the start of an audit. This will provide certainty to taxpayers and give sufficient time to SARS to audit the transaction in issue.